the question which is in everybody's mind, and I think there are some people who have already asked this question: should one wait for 2 months to enter into equity markets, or one should kind of enter right away? Hello, friends. First of all, thank you for sparing your time on Monday evening. We at PMS AIF World aspire investors to make informed investment decisions. In this pursuit, today we have a webinar, and we have amongst us Mr. Rahul Rathi from Purnartha Research and Advisory. Purnartha is a leading investment advisory firm that manages close to 5,800 crores of assets. Purnartha is a unique advisory firm in a sense that it doesn't touch investors' money, and truly works like an investment advisor. Purnartha is a unique advisory firm, and Mr. Rahul Rathi is the managing director and fund manager with Purnartha Investment Advisors Private Limited. He has a consistent track record of managing a portfolio that has delivered benchmark-beating returns via his robust research methodology, which is supported by an on-ground investigative team. He has always believed in investing in structurally solid companies. I am pleased to welcome Mr. Rahul Rathi for this webinar. Rahul, before we begin, I will just take one last minute to set the expectation for the audience. General elections are over and market are at their all-time high. However, broader indices have underperformed, especially in the last 18 months. So investors are quite anxious to know what is the way forward, whether one should invest in large caps, whether one should invest in mid caps. Valuations look expensive. They are at all-time high. So we open up for you to answer all these questions. Friends, on your right-hand side, you can see an option to ask questions. I will collate, some of these questions, and we'll try to cover, most of them in the end during Q&A session. Rahul, over to you.
Thank you, Kamal, and thank you, the whole PMS AIF World team for organizing this webinar. Good evening, dear friends and fellow investors. It's an interesting time right now. Elections have shown that India prefers stability across all regions, and the vote share has moved together in a resounding victory for Prime Minister Modi. It is actually a great achievement as an analyst to see the fact that Indian voters are maturing and they are not influenced across the historical lines that were drawn or the segments that were there. They're thinking through different economic paradigms, and this election is a testimony of some of the paradigms that have changed. But coming back to the markets, the topic that was there was broader indices have underperformed, and some of the cyclicals are what has driven the indices higher. Some of them have been very, very focused, concentrated movements of a few stocks that have driven Nifty and few other indices. Let me start the conversation by a brief introduction of what we believe and why we believe the way we do. So when I started out, I said that I had some money for myself and I wanted to invest for myself and my family. And the principle is Vasudeva Kutumbakam, which really means what is good for me and my family is good for my clients. With that principle in mind, my investment horizon was long term. So I looked at 20 or 30-year investment horizons and wanted to find out what kind of businesses created wealth, or did the stock markets create wealth for somebody who had a larger horizon, and what was the investment style that kind of met a person who wanted to create wealth over a longer time. The idea was my interest in mathematics, which says that 26% compounded over 10 years is 10 times, and 26% compounded over 20 years is 100 times. As an entrepreneur who started with a small amount of money and then created some wealth from 2002 to 2007, I said that the return for me applying my mind should at least be between 25 to 30%. If I wanted to use my time, then I needed to generate a return which is far superior to what the indices were generating. If I look at a 20-year period, there would be 4 elections, there would be events like demonetization, there would be other events like the currency crisis, everything. So my portfolio or my emotions have to be stable during all the downs and the ups. I wanted to build something where I didn't have to be too volatile emotionally or too scared or too greedy at any point in time and create a 25 to a 30% return. With this in mind, I started studying companies where, they've given about 100 times in 20 years or 1,000 times in about 32 to 33 years. So when I looked at all the companies, I found that there were two things that were common in every company. And it intuitively made sense for me that this is why the company's wealth is growing. The first part was 10% volume growth, which meant that there was a demand for the company's products and services, which also meant that the company was relevant to the current needs of a target segment or clients. The second part was identifying that whether the company was debt free or not. What I found was most companies that have delivered a large amount of wealth over 20 plus years have been significantly cash positive over a significant number of years over the 20-year journey. Essentially 18 to 19 years they've been cash positive. And when I thought about how to interpret this, I realized that it was about having pricing power. If my services or products that I build, I can charge a premium, that also means that I can have internal accruals, take care of capex and working capital. And the third part was an outcome which is 20% operating cash flow growth. So what I realized was that these three parameters became business principles, and the stock market value or asset prices were an outcome of these parameters. So if you think about it, what I think today, if I'm conservative and I put all my money in FD, then the outcome after 10 years is that my 100 rupees invested in FDs will become 200 rupees. People say that the reason is because you put it in an instrument that generates about 7% return. But really, the 7% return is an outcome of my thinking, which is conservative. So 10% volume growth and debt free were thought processes that created 100x of equity value. And these are companies like Titans, HDFC Banks, Bajaj Finance, etc. I also realized that I could apply logic to logic, and the stock market was an outcome of logic plus emotions, which is greed and fear. If I'm scared, I will take risk off the table. If I am greedy, I will put risk on the table. So essentially, the stock market returns were a combination of logic plus emotions. I could not apply logic to emotions. So I needed to ensure that I can only apply logic or analysis to logic, which is studying cash flow growth or 10% volume growth and debt free, and apply this to a portfolio. And if the outcome is a delivery of these business principles, I knew asset prices would reflect this. in a period of time, over a 3 year period, my portfolio should double every year. And if I deliver better than 10% volume growth, the portfolio will do better than, doubling every 3 years. With this in mind, I stopped looking at what the stock market does. I started looking at the inputs to whether asset prices should grow or not. Are they being achieved? Have I executed correctly or not? The stock market is the only place which gives you two major factors of success or failure. One is error of commission and second is error of omission. So every year I could go back and see whether I've executed on the philosophy, not executed on the philosophy, and the second part is what have I missed out. It allows us a continuous learning over a period of time to be able to continue to refine your thinking, your thought processes and execution capability. So the first principle or the first leg of my investment thesis was these three principles. The second one was identifying a management team that can execute on these principles. And I found that every management team had two pillars. There was a visionary who used to, spend a few hours in office and define what the company would do in the next 10 years. And a nuts and bolts guy would execute on the vision. But there were two more roles that a visionary played. The first role was, out of every 10 decisions that the company took, 3 were wrong. And his first job was to be able to cut the mistakes whenever they occurred. And the second role was to ensure that he had an execution team that continued to execute rightly on the strategy or the vision that they had. In terms of numbers, what we found was that every business had an 11-year history where there were 3 good years, 3 average years, 3 below average years, and 2 bad years. If you can get certain volume growth and be debt free in the bad years, then your ability to grow in the rest 9 years is going to be a much bigger percentage than the previous 2 years. So I lived through 2008, 2010, 2013, 2016, 2018. These 5 dates are important because these are the dates when markets corrected and your ability to maneuver through those markets is important. With this background in mind, if I want to look forward, what I see today is that markets being all-time high is an indication that some specific stocks are currently driving markets and results are going to drive markets. I don't think that it's going to be a broad-based rally going forward. There is going to be stock-based rallies and they're going to depend on performance. Second point is because of lack of funding for the smaller guys and the lack of confidence in bankers to be able to fund the gray areas, I think larger businesses are going to do better than mid caps and small caps. So I've divided the whole universe into 2 parts: high growth companies, low growth companies, and hope based companies. I think in the next 1 year, data driven companies and especially companies where there is an EBITDA margin expansion will continue to do well compared to some of the other styles that are there. If you look at the last year, a large percentage of companies that did well, and it's very easy to cross check, you just have to run a model which has returned high and look at their performance. It has been companies where EBITDA margin has remained the same or increased, and volume growth has been flat or reasonably high. Any company that lost EBITDA margins did not do well. I think this will continue for the next few months. The next 2 weeks are critical because you've got to find out what the government's 100-day plan is, which they will put out in action, and the movements of key bureaucrats. Which sectors are they focused on? Are they going to be focused on the last man standing, which means that it's mostly social agenda rather than an economic agenda, versus an economic agenda and the social agenda is a close second? Identifying how people move within the government is going to be key to decide. The third part, which is very important, is economically, is how RBI decides to instill confidence in the banking sector, because money is going to be the oxygen for some of the growth that companies or sectors see. And if there is a crisis of confidence, then this growth of funding or the funding need for the gray areas is going to be low. So my bet on mid caps and small caps will be predicated on my confidence of the banking sector to be able to fund some of the growth needs of the small and the mid-sized businesses is. The large businesses that I own and track don't have a funding requirement today. Most of them have internal accruals to take care of their capex and working capital. By the way, today capex is at a year low and there is a freeze on capex in some industries because demand has not panned out last year the way it was expected. So I would wait for some time to find out if demand has come back before getting into mid caps or small caps. Delivering a 25 to a 35% operating cash flow growth because of margin expansion should not be that difficult this year, given that a lot of people have had margin contraction in the last 1 year, and that is why they are seeing a 30% contraction or a 20% contraction in asset prices. The last thing is valuations. And my expectation of valuations is that it will depend on whether there will be global cuts on interest rates or not. And this will depend on what happens between US and China. If the RBI governor cuts interest rates in favor of growth and he's far better placed than many of the other economies, you should see a re-rating of some of the businesses that you own. And this will also help drive returns. I think there is a margin or there is an interest rate cut expected, but it also depends on how much asset prices will react, will also depend on what the global cues on interest rates are going to be. I want to stop here and answer questions through the Q&A and share some of the insights that are relevant to the people right here. So let me hand it over and take questions going forward.
Thanks, Rahul, for the insightful session. So, we have had actually a couple of questions. And first series of questions are primarily coming on your view about the NBFC sector. In last 6 months, we have seen a lot of pain in the NBFC sector. What are your views on that? Because there are a lot of stocks in the NBFC sector which are trading at lower valuations and they are in the mid-cap space only. So over to you with regards to this.
So if I look at the NBFC sector or the finance sector in India, it is not about lending. It is about ability to collect from a borrower, and this ability and capability differentiates the big boys and the small guys. I think some of the smaller NBFCs, their ability to collect is suspect. So if you look at a Kotak Bank or an HDFC Bank or a Bajaj Finance, their ability to collect from any segment continues to improve. So then the business all becomes about pricing the right level of risk and then collecting from those players. So the challenge, so if you are able to identify a good NBFC with good capability of collections, you will not have a challenge. If there is a capability problem there, then you will have to shift to a better NBFC. Having said that, I think valuations will also depend on what the RBI does for this sector. And I think the RBI is coming out with a policy to enhance liquidity within the NBFCs. And you might see some asset prices increase, but structurally, if you can find an NBFC which has good collection capability, it is better to bet on them rather than pick up any NBFC that is just cheap on its valuation basis, because value can become deep value pretty soon.
Right. Thank you so much, Rahul. So the second question comes on the infrastructure sector. In last couple of trading sessions, we have seen a lot of construction companies and a lot of infrastructure companies that have led the rally. So there are, clients, there are investors who are wanting to know what are your views going forward on infrastructure and construction sector.
I think you'll have to wait for the government's diktat on what the next 100 days are going to be and what their focus is. So this is an expectation of continuation of what Modi said in his speech to everybody. And what the first 100 days are will define whether infrastructure is a focus in the first 100 days or not, or in the first 6 or 9 months or not. And depending on that, you can take a call on them. I don't own businesses that have debt, and a large percentage of infrastructure businesses are debt driven. So I would not be able to comment on specific names. This is just a broad view on the infrastructure space.
Right. Thank you, Rahul. So the third question comes on the consumer discretionary space. So over last 3-4 years, this sector has actually participated and delivered a lot. What are your views going forward with regards to consumer companies? Are we going to see the valuations tapering off because the valuations seem to be high?
I don't think that valuations will taper. I think every year India adds about 4 crore consumers to its consumer, to the consumer economy. And these 4 crore customers come from, 1,800 or $2,000 GDP per capita moving up, which benefits a few, and some of them who get educated and come out in the job market. Both these criterion ensure there is a large demand for consumer economy in India, and there might be a delay in consumer economy, but they will transact at some point. So consumer discretionary, if you hold the good names, they have seen they seem expensive because of EBITDA margin contractions or no volume growth coming in, or a combination of both. I would not worry more about valuations, because as interest rates come down, these businesses, if they're debt free, will continue to enjoy the benefit of the consumer economy as long as they meet a certain business principles. I'm not too worried about the valuations.
Sure, right, Rahul. So, it is the question which is in everybody's mind, and I think, there are some people who have already asked this question. Should one wait for 2 months to enter into equity markets, or, one should kind of enter right away?
It really is an emotional decision about whether you want to enter now or later. So compounding says that time in the market is better than timing the market. At the same time, if you're going to, question every decision of yours because the market fell, or reward yourself because the market went up, then, it's more driven by emotion than rationality. Um, I'll tell you personally, I am going to wait for a week or 2 weeks to find out what the government focus is and then deploy money, because I think some of the euphoria will die down and reality will settle in, and that's when you will get some bargains. But, it doesn't matter whether I enter today or not if I find a good name. If I find something which is very attractive today, I will enter it today. I don't think I will hold on
Right.
beyond 4 weeks. So 4 weeks is maximum what I'll hold on to cash.
Right, Rahul. So there are, interestingly, couple of people, couple of investors, I think, who have logged in, who are already invested in Purnartha's product, and some of them are employees in Purnartha. So they are specifically wanting to ask a question on two stocks. One is on Bajaj Finance, second is on DMart. So what are your views, with regards to the premium valuations? Do you think in 1920 the valuations will kind of show the robustness, or you see, some kind of de-rating happening there?
So if you look at Bajaj Finance, so my philosophy also came from the fact that if you look at Amazon in 20 years in the US economy has delivered from $2 billion market cap to $1 trillion. And the second thing was Warren Buffett, 54 years of 19%, PAT margin growth or book value growth. I think that good companies can continue to grow. If I look at Bajaj Finance has done well on both fronts, on the NIM front as well as on the volume growth front. So it continues to see an opportunity going forward, and this was true in 2016, 2013, and 2018. What is happening is because of their ability to collect, their ability to price products and continue to grow in segments which others are not competitive is very high. So as long as the growth continues, I'm very comfortable holding the business. In terms of DMart, what I found was that it is trading currently at a 20%. So DMart's 1 year, it has given about a 15% low negative return, and this has been because EBITDA margins have shrunk. I think in the next 2 or 3 years, if they continue on their growth path and EBITDA margins come back to the average that they enjoyed historically, you might see a re-rating on the other side today. In terms of valuation, when you look at growth stocks, it is not expensive. Titan is the most expensive stock in terms of growth today compared to even DMart.
Right. Thank you, Rahul. So the next question comes on auto sector. Over the last 6 months, auto sector has corrected quite a bit. Markets are at their all-time high, but auto sector has is down almost 30%. So what are your views with regards to auto sector in financial year 1920?
I think the auto sector is going to suffer the crisis of confidence in the banking sector. So 80% of autos are bought on debt. And the fact that NBFCs are not lending today because of challenges means that there is a problem with the auto sector doing well. So I'll give you an example. So when bankers start lending to a business, they initially lend based on operating cash flows. Then once they get comfortable with the businessman, they'll say, okay, I know your operating cash flows will not suppose extra debt, but refinancing will. And let me give you some more money, and then you can refinance it at a certain period of time. But today, there is a crisis of confidence and there's no refinancing happening. So think about Ola or Uber drivers. People used to finance them because they believed that Ola and Uber drivers had no credit history. But because of the business history, they said that, okay, we'll take a business risk. Today, nobody is willing to take that kind of risk. People say that unless you have a good credit history and you have a good business viability, then only will we finance you. This makes a large percentage of borrowers outside the current opportunity of buying cars. So the growth will be muted, and once the confidence gets back into the banking system, you'll start seeing auto sector do. But this is not the current time to enter the auto sector. Sorry, I can't hear you.
Yeah, I'm saying thank you so much. We'll take one last question, which comes on Purnartha's research methodology. Your portfolio is quite concentrated, and the 10-year history talks about great amount of returns. However, there are investors who want to know what are the three things that you look for when you identify a stock to be picked in your portfolio, and then what are the signals that make you kind of feel not good about the stock and you take an exit call.
So I'm assuming that some of them are new customers. So the challenge is that last year has been very challenging, and the challenge has been because when I look at it, so the stock market gives us our ability to analyze whether we have made mistakes or not. So you go back and see which stocks have done well, did they fit your philosophy, and which stocks have done badly. And what we found is that there have been challenges in our execution of the methodology, and we are happy to correct them. So we've done some changes in our research to be able to do it. But today, if I look at a new stock, what I'm going to look at is whether there has been volume growth historically, does it continue in challenging times, and what are its current EBITDA margins? Are they higher than a 3-year normal, or are they lower than a 3-year normal? If they are lower than a 3-year normal, then I look at whether their ability to come back to original margins is there or not there. And that's how I will invest today. The second part is, when do I get uncomfortable with a stock? When I see inability of the business to attract customers, or I see inability of the business to manage their capex to maintain a certain customer growth. If there is changes to the long-term mean for both these parameters, that makes me uncomfortable. The third thing is, I'm not worried about mistakes. So the last thing is, I made some mistakes last year and I'm getting out of them, but I'm not worried about mistakes. The reason I'm not worried about mistakes is I learn from my mistakes and I learn what not to do from my mistakes. So I've seen over the last 10 years, it's not the mistakes that hurt us, it's inability to identify and correct those mistakes is what has hurt us.
Right, Rahul. So I will just take your permission to ask two more questions. There are,
Sure.
interesting questions. Yeah. So we have seen general election result outcome. So with regards to domestic front, this was the largest risk, which was kind of making investors wait and watch. But on international front, what are your views with regards to the possible risks given the US-China tensions, given the crude price movement, or any other possible international risks that you see that may kind of portray over a period of say financial year 1920?
Actually, India is the sweet spot for the risks that are there. So the real risks are that costs will go up for countries, and some of the products that they're used to, they'll have to pay a much higher price for them. The other challenge is that everybody will move back, their confidence levels will be shaken, and they'll move back to being conservative rather than aggressive. This is also about China's, so US buys a lot of stuff from China, but China still doesn't allow Google or WhatsApp to operate there. So I'm sure there are some IP related things or some equilibrium that needs to be bought between US and China, and that is what Trump is hoping for. The reason why we benefit is we are the only consumer related economy that continues to have consumers added to the economy. So if somebody wants to compound their money, we will benefit from everybody else not doing as well today. I think global growth will slow down, and global growth slowing down with companies that are levered up to assume a certain global growth will be forced to look at India as a market to continue, and will definitely try and enter India at terms and conditions that might be favorable to India. So all in all, I'm hopeful about India over the next 10 to 12 months. There will be volatility, but over the next 5 years, I'm sure we will be able to do well. And frankly, I wasn't worried about the elections. The big worry for India is today is who's going to be the finance minister and what is his understanding of what the economy needs today. The team is there and they have a certain understanding of what the economic needs are for the country of our size and complexity. If we get a finance minister whose understanding is also high, the volatility might not be 10 months, it might just be 1 week.
Sure. Right, Rahul. So, what are your last, words of wisdom for investors who have been kind of waiting on at the fence and are wanting to enter into equity markets and are evaluating products like PMSs, products like mutual funds, products like advisory services? What are the words of wisdom in terms of, how an investor should approach and select, some of these products for himself? Over to you.
Yeah, I think there are two questions out here. Let me answer the first question. The first question comes from when should people enter and whether timing the market is better strategy than time in the market. For people for all the investors who've been there for 10 plus years, and have bought HDFC and sold HDFC, their returns are much lower than ability to hold HDFC over the last 10 years or HDFC Bank over the last 10 years. So I have enough data to prove that time in the market is far more valuable than timing the market. The second question is how should choose your team, or who should be on your team to manage your money? And this is an important question because for you have to find out people, whether you invest in AIFs or PMSs, ultimately you're betting on somebody who's on your team and how much time you give and whether there is a method to the madness. I'll only put in two criterion. If I had to choose my team, this is what I would look at. The first criterion would be is his own money invested where his mind is? If this guy is capable and has a certain amount of is using his capability for you, why he should be using it for himself also? And the second thing is, how does he go through the tough times? Does he learn from the tough times and mistakes, or does he continue believing in a certain way regardless of what happens? I think those are the two parameters that I would choose in a person whom I would like to be on my team. And 1 versus 100. This is versus if I go back to the Kauravas and the Pandavas, Arjun chose Krishna versus Kauravas got his whole army. So I still believe in concentration, and I've seen that work across philosophy, across people who have created wealth.
Sure. Thank you so much, Rahul, for such an insightful session. So just to thank you everyone, for logging in for this session. Just to give a little bit brief about PMS and AIF, we have a lot of platforms which give a lot of information about mutual funds. But PMS and AIF is the first platform that we have launched, where we are wanting investors to make informed investment decision, by comparing portfolios, by comparing sectors, by comparing expense of each and every portfolio in that product. So, in line with what you are recommending and what your thoughts are, we also believe the same. We also have a business punchline which says make an informed investment decision. And with this, I would end this webinar. And thank you, Rahul, for your time. We will again connect shortly.
Thank you very much. Good luck to everybody. Thank you. Bye.